Hi, students. Here's a little overview of the calculations. I know it was hard to see on the screen on Tuesday night for the Gainsboro machine tool case. And again, this case is about the ability to pay dividends and while still maintaining the required debt to equity ratio. I'm going to just put this 15 minutes of the screencast into these exhibits that we showed at the closer to the end of class. And this is the forecast. This is if they have this dividend policy, and the dividend policy is up here. Is 40% is the base case. Oops, you just saw that. Snooze. Is 40%, and they're assuming, being in the new business of CAD/CAM, 15% growth. The margins are going to do this, which are, again, they know the business and they know what to expect in the margin. The first year, the margin's only going to be 2.1%, but it's going to grow up to 8% by 2011. And they're starting out with $80 million in debt, $282.5 million in book equity, which they use to calculate their debt-to-equity ratio. They have 18.6 million shares. This is what the price-to-earnings ratio is. And if you can see up here, this price-to-earnings ratio, you can read this in the formula bar, shows that it is 75% the average from the what we saw earlier from the industry that they want to be in, CAD/CAM companies they're already in, that they expect to be in, and 25% from the other things they're doing. So these lower, I mean, they're being realistic. They're not saying they're going to be 100% business in here, but they're going to recognize that if the market sees what they're doing and the expectation in value set in terms of the price of a stock given a dollar's worth of earning in the industry will be a blend of those two. So that's where they get the 24.6. I know that was raised in class. Where do they get that number? And we said it was based on the industry. The current market price is $22.15, and they cannot allow debt to equity to go above 40%. So and they borrow at 6%, and that's meaningful too, and they pay 35% in taxes, which is part of the cash flow. So we have an abbreviated or summarized cash flow statement here based on these sales. And again, the sales is a formula that they're looking at the sales from the previous year, that's this number here, and times the growth rate, which is plus that times that. The 15% growth rate is the C7 here. So they're doing this, here's what they expect to happen to sales. And the income is going to be a function of the margin times the sales. So they're saying that a net interest margin, a net income margin of 4% of the new sales of $1 billion. Depreciation is kind of a given number. It's a hard cut from, we saw that on another one, and it relates to the fixed assets. I guess we saw that again in another exhibit. So their total sources of cash, because we're going from net income, which is not a cash number, because it excludes, it treats depreciation as an expense, but in fact depreciation isn't cash. It's just measuring the change in the value of the fixed assets and charging it against the income. And so since it's non-cash related, you get to add it back. So the total sources of cash in 2005 are going to be $40.8 million. That's from the operations activity. The uses of cash, at least from operations, go to the capital expenditures, the assets that they have bought, and we see that again. It's just hard. It's just given, and some working capital that they have to buy. That's inventory and the growth in accounts receivable, as we've discussed. It added net of the accounts payable that might be there. So that's the use of cash. They have to spend money to get that stuff to grow, to increase the sales. So the difference between sources and uses leaves them with a cash flow deficit. They're generating a smaller amount of cash in operations and they're spending in operations. So they have to borrow the difference. So that minus that leaves them with excess cash or borrowing. So if it's a negative number here in parentheses, it means they have to borrow. These years, they cross the line. They now have $4.2 million more in cash, and it grows on. So they don't have to borrow anymore. They can pay off debt. When they do this, excess cash can be used to pay off debt that they have and maintain that ratio. Now, here's another use of cash, and that's paying that dividend of 40% to their shareholders. So that cash leaves the business. So since that's leaving the business, that's going to increase their net cash, and is going to have to go to, this is called cash from financing activities in the classic cash flow statement. That the net cash has to is negative throughout until you get to 2011, and it finally there's enough business cash flow generated in the operations to not only cover operations but also to pay dividends at the 40% of revenue. Oh, sorry, of income. Sorry, mixing words there. I didn't have my coffee yet. So cumulative sources means how much they have to borrow, added, additional debt. So this is or the or need is what they have to borrow. Sources what they have. Now, remember, since they have to borrow, they're going to have to spend some cash to pay interest on that, and they have this in here too. So their net sources needs goes up to this. Okay, the debt will be the incremental, the debt that they had at the beginning, which was $80 million, plus the $31 million that they needed because their operations and dividends required more cash and interest, and so now they need their debt has increased to $113 million. The following year, $136 million, and so on. Equity goes up too because they are earning money, net income of $40 million. And of course, they subtract the dividend from that because that equity is now what's left in the business. And I'll show you the formula here. It was the previous year's equity plus the next year's earnings minus dividends, and this is a reduction in earnings. Of course, they're looking at the net income here without the incremental debt because they're just basing it on this ratio of the net margin, and so it has to change with the levels in debt. It has to be sensitive to the dividend number. So the equity gets bigger because of revenue, but smaller because of the dividend that they pay out, and smaller again because they have to borrow money and pay the interest on it. So this is what's happening to equity, and it is this ratio of that number divided by that number that tells them if they are satisfying their rules of a debt-to-equity ratio. And in this case, they are, because they're under 40%, but all throughout until the last month, they are not. And here's the picture of that. We had a picture somewhere. Where'd the picture go? There it is. See, that's the 40%. They went over their limit of 40%. Then this corresponds to the 40% payout ratio, complicated debt to equity, and then finally by 2011 they were back under it. So they can't pay out a 40% dividend while with all the other numbers going on. With this level of income margin, this level of growth, they can't pay the 40% dividend, or they break their own rules. And those rules can be set, and we'll talk later about debt policy and setting capital structure in a later case. Finally, we're going to look at what this does to the value of the stock, because remember the Modigliani principle states that dividends are more or less irrelevant. Transaction costs. I mean, they have to understand. They have to assume interest rate debt and interest-free debt and all of those things. But you want to see that it doesn't really the payout rate doesn't make a big change in the value. And the value of the business is measured in terms of what are these future cash flows discounted at a discount rate? What do they, what have they achieved in the growth in shareholder wealth? So the shareholder pays $22.15 for the stock, and the company's stock price follows this pattern thanks to this is the earnings per share. Again, that's just the earnings estimated from net income, which is the margin times the sales, and divided by the number of shares outstanding, which is this number here, 18.6. So you can see that this price is estimated, again, the earnings per share is earnings by number of share, and we need that because we're going to base the stock value on the price to earnings multiple that the market assigns. The market's willing to pay for a dollar's worth of earnings in those combined industries, a 75% CAD/CAM, 25% the old business, machine tools. So as a result of their growth in earnings, this is what happens to the share price. You see the cursor moving. 91, it goes all the way up to $208.49. So what is the investor getting? Well, at the 40% dividend payout rate, the first year they're getting a 39-cent dividend. The second year, 86. These are the dividend flows. And so each year that they get this in the future, so based on this strategy over the next 5 years, the wealth created for the shareholder based on the combination of these dividends and the fact that 5 years into the future, they will have hold a stock worth $208.49, and they'll get this big dividend. So they'll have this cash flow in 5 years. You discount each of these cash flows and add the discounted rate. Add them together, sum them, and take at the present and take the sum of the present values, and add this to the negative 2215, and that's how this formula works. I'll highlight this formula. It is the net present value at a 12% discount rate. That's given, typically weighted average cost of capital, and this is the sum of the cash inflows plus, which is, since it's a negative number, that's how you do it in Excel, the cash outflow. That's a return to the shareholder, an increase in the shareholder's wealth of $78.82 per share. And that results in a 40.2% IRR. Now, as you can see from this, if you can read this, and you put a little parentheses there, is that, remember this one, is that the growth rate, I did this backwards, DPS, sorry, this is going to kill my time. Oops. But the growth rate is, again, I'll make this bigger. 1 minus this is the dividend payout ratio here, DPS divided by EPS. So how much of the dividend they pay of earnings times ROE. So this number, if they pay out a big dividend, then the growth rate is going to be lower. And that's what's being calculated here. They're going to and they're actually not doing it this way, but this is the theoretical way, that if whatever I pay in dividend is less left behind to grow. So if I pay a zero dividend, if the company does, not me, I don't have any money, I don't own a company, and nobody'd ever let me run it, to zero, then there is no dividend income, but the company is allowed to grow because the EPS is higher, because this number is higher because let me put this in here. EPS, there's a smaller amount borrowed. You see that this EPS is affected by cost of debt. So the cost of debt being these numbers here, because they're having to borrow in order to meet the cash shortfall. If they don't have to, they're using their own money, they don't have to use cash to borrow. So this debt is a drag on EPS, and if the debt gets smaller, then it's a smaller drag, and this number gets bigger, and that number times, and this EPS number times the multiple up here, I'm jumping around a little bit, of 24.6, results in a bigger number here. And now this cash flow of a single payment value of $219.63, discounted after 5 years with no dividends along the way, this results in $77.20. So it's not as attractive as paying the dividend of $78.82, because even with the interest on debt, it is better to pay that dividend from the shareholder standpoint by $1.60 some odd in present value. And you can see how this table shows you a 30% dividend rate, payout rate at 78, and so it's tough. And the reason for all of that is that the interest does not reduce the EPS by as much as the benefit of the dividend and the timing of the dividend, because you get the cash earlier and that cash can be reinvested. Remember that